That's the biggest mistake I think I see people make is they don't know what they're building before they start building it. And then they do a hybrid or they do something where they pay the agents a lot, but also spend a lot on the agents and they wonder why there's no money left over. That was what I was doing when I first realized I was not running a business, I was running a charity.
What have you seen from reorganizing everything and taking a step back and looking at the business in terms of numbers and how it should be divvied up, what you're spending on lead generation, what you're spending on staff and stuff like that? What did you learn that you were doing wrong that you had to adjust?
Well, I mean, the biggest thing is that I just didn't have a plan. I can share my screen a little bit and we can talk about what we call the 5 simple numbers. In the real estate world, there are 5 numbers that we learned that if we had a model that we were following around those 5 numbers, we would have success. Essentially, there's 5 numbers you got to be aware of. And you have to have a plan in place to make sure you're hitting the numbers that you want, your margins in your business. And that tends to have the largest profit margin as long as it follows a certain model. So that's the biggest mistake I think I see people make is they don't know what they're building before they start building it. And then they do a hybrid or they do something where they pay the agents a lot, but also spend a lot on the agents and they wonder why there's no money left over. That was what I was doing when I first realized I was not running a business. I was running a charity.
Yeah.
I was not making money. So if we track what our numbers are in the format of what we call the 5 simple numbers, then we can have clarity from our books. And it's one thing to hire a CPA to do our books for tax purposes, but the real value, honestly, in bookkeeping has nothing to do with taxes. And it has everything to do with understanding what model you are currently running in your business. And I'm surprised, amazed by the amount of top teams, like big production teams and medium size and small, that have no idea what model they are running. They get to the end of the year and they look at the amount of profit they have. They compare it to their friends and they compare it to what they did last year. And that's about all that they do. And that's a recipe, in my opinion, for disaster, especially when you compare to other teams, because we're comparing apples and oranges. Everybody can make their books look any way that they want.
Yeah.
And so, the format of the 5 simple numbers is really the key, I think, to bringing clarity to your business.
That's a really good point, because one of the biggest coaches for leadership that Colton introduced us to, John and I had a call with him 7 months ago. The first thing he asked us on the call, he was like, what's the percentage of gross that you're spending on staff? And we were just like, And then he was like, it should never go over, I forgot the number. I think it was like 30%. It should never go over 30 or something like that. But
less than that.
Was it like 13%, something like that? I don't even remember, but we'll go over it right now, I guess.
Yeah. And really it depends on the model that you're looking to build. And again, that goes back to
what you want, the end in mind.
Making sure you know what it is you're building. There's no right or wrong way to do this. There are brokerages out there that make good money and they have hundreds of agents and they have a slim percentage profit, but the number is great because they have such a large top line revenue number. And if that's the model you're building, okay, then let's talk about what that should look like. If we're doing a different model, then there's a different thing. Regardless though, all of the businesses run the 5 simple numbers. No matter what business we work with, as far as real estate goes, no matter what model, they all have these 5 numbers. So if it's all right, let's jump into kind of what those 5 numbers are. And I've got I've got a screen up here that I'll share, and we'll just kind of go through each one so you can see this. You have to first imagine your business like a pie, right? And that pie is your revenue. So that's simple number 1 of the 5 simple numbers is, what is your total revenue? One of the things I find people make a mistake around this number, mostly because they hire CPAs that don't understand the real estate business, or they have bookkeepers that don't understand the real estate business. Your total revenue is the dollar amount before anybody touched anything from that commission. So for example, your broker, you might have a split arrangement with a broker or a cap, whatever it is, and your broker is going to take a portion of every dollar from commission income. Well, we want to look at the total revenue, not the amount after your broker took their portion. Same with agents. We want to look at the total revenue, not the amount after you paid your agent their portion, because we want to get a true picture of the top line total revenue of the business. Another mistake I see people make with total revenue is they include things like revenue share or profit share from their brokerage. And that is not part of your real estate team. If you are building a real estate team, that is a separate business from the revenue share or profit share or any other revenue that you might be getting from another business, personal rental income, things like that. So when we talk about the 5 simple numbers of your real estate team, that pie, we're talking about total revenue is the total revenue before anybody touched anything just from your real estate sales business, if that makes sense.
Yep.
So, and those are some of the mistakes. The second number we have to keep track of, and this is the first piece of pie that gets cut out, and that is what I was just referring to, your costs of sale or costs of goods sold, the amount that goes out to the agents and the broker. So if you have splits set up with your agents and your broker also takes a portion, that's what we would call your costs of goods sold, right? It goes out. So are you seeing this revenue hit your bank account? No. And that's why a lot of CPAs and bookkeepers don't include it when they show your revenue in your books because they don't see the point of it. But that's because they're not looking at your books like a real estate CEO or a CFO, right? And we really need to understand how much of the pie goes out to your agents and broker, because if it's too high, you're not going to be able to spend the amount of money you want on expenses and still have any profit left over. And that's the mistake a lot of people make.
Yeah, but you won't know it's too high unless you have it on there.
Yeah, you won't. You'll have no idea.
I mean? Like, or maybe like from your perspective, right? Like, let's just say, for instance, that your team is at a Berkshire Hathaway. I don't know why I'm picking on them today, and your cap with them is $40,000, right? The way that most people do their books is they put what's left onto their P&L, right? That's where they start with their revenue. But what you're suggesting is take the initial number, show what you're paying to your broker in the cost of goods sold, right? So that I think when then you're comparing that agent's books just mentally to another team, you can bring it up to the agent and say, hey, you're paying a lot to your cap or to your broker or to Berkshire Hathaway, whoever it may be. It just, like you said, it's not apples to apples unless you're including that.
Yeah, it really isn't. And I see the more of the issue is around the splits with the agents. That's where most agents get this messed up when they start building a team, right? They'll just do like a 50-50 flat split with everybody on the listing and the buy side and so on. So when we set up your books, at least when you work with simple numbers, and if you don't work with us, you need to have your bookkeeper do this, but they need to put in the total revenue, the amount you brought in on the buy side of your business and the listing side of your business separately. And then we need to look at the cost of goods sold from the buy side and the listing side, because you really need to understand that the real profit driver in your business is the listing side of your business, because you should have different splits on that side than the buy side, because that side of the business is highly leveraged with systems and people, right? And you're paying for photography and you're paying for all these things, and you don't have to pay the same split to the agent that you do on the buy side in most cases. And so really, regardless of what model you run, and if you have different splits on the list side or buy side, you need to understand how much is going out of every dollar that comes in to do your sale. This would be no different than if you owned a restaurant and you were selling a plate of food for $10. You need to know how much the food on that plate costs you. Yeah. In real estate, the food on the plate is the amount you paid out to your broker and agents. It's what you had to pay to get the deal done. You had to pay someone that money. You never actually saw it. So that's your cost of goods sold without going too far down that trail. Yeah. That's your cost of goods sold. That's simple number 2. Then the third one is what you have left. That's the rest of the pie. That's called your gross profit. And, John, to your point, this is where most people start with their books. They start with their gross profit and call it total revenue. And they never include their cost of sale. And then we just don't have clarity on how much of every dollar is going out the window,
Andy, just to clarify, so for a team, cost of sales is what you're paying the agents, what you're paying for leads that are generated, or just what you're paying?
Not yet.
No leads, just the people expenses around the sale. So essentially, the best way to explain cost of goods sold for a real estate team is if you owe someone money at closing as the team leader or the team owner, that's a cost of goods sold. Right? You pre-agreed that at sale, you're going to get a portion of this money. Nice. So typically the majority, that's going to be your broker and agent costs. If you have ISAs and you pay them a portion of the revenue, you could consider that a cost of goods sold. And there are other minor things that might be included in there, like referral fees out to other agents in other parts of the country or whatever. Yep. But it's anything that goes out that really isn't part of your gross profit or the money that hits your bank account. So That's simple number 3 is gross profit. It's also referred to as real revenue because it's the money that you actually saw hit your bank account. So those are some other terms there for people that may use different ones. But at the end of the day, it's the money you have to work with as the team leader. Now, we have to now do things with that money. We have to pay our bills. And that, KIRO, that was going to your point of like, well, then there's other expenses like leads and so on. That's simple number 4. Your operating expenses, right? What are you going to spend to run this business? And what's cool I'm all about making things simple. If you guys haven't taught, 5 numbers to understand your entire financial business. Yeah. And you'll get a whole P&L from your CPA or from your bookkeeper or us if you work with us, and it'll have all these numbers on it. There are only 5 that matter. And the cool thing about your expenses, there's only 3 categories of expenses. So every dollar you spend in your business is going to fit into one of 3 categories. It's either going to be a people expense, a marketing expense, or an overhead expense. Okay. And very briefly, people expense is any dollar you spend on a person in your business, your staff people, even if it's a per transaction coordinator. If that dollar is spent as a people expense in your business outside of your agents and broker, then it is a people expense. So this is going to be typically your admin and those types of people. The second is marketing, lead gen and marketing. We call it LGM. So it's any dollar spent with the intention of generating a lead or an opportunity for the team. And then everything else is overhead. So anything that's not a people or marketing expense is overhead. And these are the 3 categories. Every dollar you spend should fit into one of those 3 categories. And that's really it for expenses, right? And I'll talk a little bit about what those should be, kind of what you should plan for around expenses. But, at the end of the day, there are only 3 categories. You need to be looking at those 3 every month and making sure you're following the plan that you've set out for yourself around expenses. And then, of course, that leaves you with the third piece of the pie. That is your net profit and any owner pay. That's number 5. So that's the green area in the slide that I'm sharing, but it's basically the third piece of pie, and that's yours. You get to split that with the government, but that is what is left. And it's either going to be an amount you planned on or not, but it is what you have left after you paid your agents and broker their cost of sale and you paid your bills. Yeah. So it really is that simple when it comes to the simple numbers.
I'm realizing it's such a definition issue that it gets misunderstood. And I'm looking at the pie cost of sales. I'm like, there's no way, if the people are that you're giving out splits to, so then you'd have to lower the splits to make it make sense across the board.
Well, what's interesting though too is let's just talk about cost of sale for a second. So for instance, you said, I think I'm reviewing my notes from when we first did the webinar, cost of sale, if I'm reading this correctly, if I'm remembering correctly, should be about 33% if I'm out of production. Is that correct?
Yes, that's the model that I ran, right? So I ran a perfect third model, right? We split the pie in 3. So I had 33 to 35% cost of goods sold on average. We had, 30 to 35% expenses, or 33 on average expenses. I did 10% in each category, 10% people, 10% marketing, 10% overhead. And then I had 30 to 35% left in net profit and owner pay. And we did about $2 million in GCI. And so that was the model that we ran on a $2 million GCI team with me not selling a single home.
That's awesome.
Right. And so that is I'm not going to lie, that is a tough model to run, especially as the market tightens up, gets more competitive.
Just in closing here, you talked about on one of the prior webinars that we did, the 3 different lenses to look at your company: IRS, right, CPA, and CEO. So I thought that was probably a good segue after you're talking about.
Yeah, I skipped over that a little bit on this one. But yeah, that's the key here, guys, is the IRS is going to look at your books from their perspective, which is, did you pay us as much as we could possibly get? That's their job. And sounds like there's 80,000 more of them out there doing that as of our new president. And so, they're going to be out there looking to make sure you pay them as much as they can. That's one reason we need to do our books. The second reason is because our accountant wants to keep the IRS happy and they want to not be liable for anything. So they're going to set up the books in a certain way and make sure things are deducted and not deducted and what you can and can't deduct and all that stuff. But that still doesn't tell you, are you running the business that you're hoping to build economically? Are you running the right economic model? And if not, how far off are you? And if you're off, where? And that's where it's lost in translation, and people get frustrated with their numbers because they don't bring any value to them other than how much can I save in taxes?
Right.
And that's where the lens of the CEO comes in. And that's why I encourage everyone to keep it simple. Find your 5 numbers in your books. If you don't have books, get books. Hire us to do them. Hire someone to do them. You should not be doing books yourself. You have higher use of your time. But you got to look at them through the eyes of the CEO. What is my business? What do my books tell me about the health of my business? And probably the biggest mistake I see around this is people run personal things through the business that we would consider to be indirect expenses. They're really not hard business expenses, but they're trying to decrease their tax liability because their good CPA, whose job is to decrease your tax liability, told them to do that. And then they look at their net and they say, man, is that all the money I made? And it's not, because they're not looking at their books through the lens of the CEO by stripping out some of those personal expenses and understanding their real business expenses that are going through the business.
Like, for instance, like your car, right? Some people say, should I run it through? Should I not? And it can really skew things if you don't look at it.
Car travel's a big one. I see people traveling, and I used to do this all the time too. I'd go on a vacation and maybe do a real estate event and then add a bunch of days for vacation. Well, those extra 10 days, was it really for business?
Yeah. Sure.
My P&L is going to show 10 grand less in net profit. But in fact, I actually did profit that 10 grand. I just chose to spend it and run it through the business. That's profit, guys. Yeah. And so we need to consider that profit when we're looking at the health of the business, if that makes sense.
I wholeheartedly believe the biggest mistake business owners, realtors, entrepreneurs do is try to manage these numbers themselves instead of hiring a professional to do it for them. Because if you're wearing multiple hats, the last thing you care about is tracking some numbers. Yeah. And although they carry so much importance.